Today, we have a special topic that many of you will like: 7 investing habits to retire early, with insights from the renowned financial expert, Dave Ramsey. If you're new here, don't forget to hit that subscribe button and the notification bell so you never miss out on our financial wisdom. Introduction to Dave Ramsey. Dave Ramsey's influence in the personal finance sphere is nothing short of remarkable. With a career spanning over 4 decades, he has established himself as a trusted financial expert, author, and radio host. His journey began in the early 80s when he experienced the harsh consequences of mismanaging his own finances, leading him to bankruptcy. This humbling experience sparked his determination to not only rebuild his life but also to help others avoid similar pitfalls. Through his best-selling books such as The Total Money Makeover and his nationally syndicated radio show, The Dave Ramsey Show, he has empowered countless individuals and families to take control of their financial destinies. Dave's philosophy revolves around fundamental principles like living within your means, eliminating debt, and saving aggressively. His practical, no-nonsense approach resonates with people from all walks of life. Today, we embark on a journey through Dave Ramsey's top 7 investing habits, distilled from years of experience and wisdom. These habits aren't just about accumulating wealth. They're about securing your financial future and retiring early with peace of mind. So let's delve into these habits and discover how they can transform your financial life. Habit number 1. Invest in mutual funds. Investing in mutual funds is a cornerstone of Dave Ramsey's investment philosophy, and for a good reason. Mutual funds offer a simple and effective way for individuals to participate in the stock market without needing in-depth knowledge of individual stocks or bonds. What makes mutual funds particularly attractive is their inherent diversification. By pooling money from many investors, a mutual fund can spread its investments across a wide range of assets, which helps reduce risk. Dave specifically recommends growth stock mutual funds, which focus on companies with potential for long-term growth. These funds can offer the kind of returns that can help you build wealth over time. Moreover, mutual funds are managed by professionals who make investment decisions on behalf of the fund's investors. This relieves you of the burden of day-to-day investment decisions, making it an excellent choice for those who want a hands-off approach. In summary, mutual funds align perfectly with Dave Ramsey's philosophy of simplicity and diversification. They provide an accessible avenue for anyone to participate in the market's growth while managing risk effectively. So, when considering your investment strategy, keep habit number 1 in mind as a foundational building block for your financial future. Habit number 2. Consistent contributions. Consistent contributions might sound simple, but it's a fundamental key to successful investing, according to Dave Ramsey. The power of consistency cannot be overstated when it comes to building wealth over time. Automatic contributions are like the heartbeat of your investment strategy. By setting up regular contributions to your investment accounts, you're not only making investing a habit, but you're also taking advantage of the principle of dollar-cost averaging. This means you're buying more shares when prices are low and fewer when prices are high, ultimately lowering your average cost per share over time. Consistency also helps you weather the storms of market volatility. Instead of trying to time the market, which is notoriously difficult and often counterproductive, you're steadily growing your investments. Even during market downturns, you're accumulating assets at a lower cost, positioning yourself for the potential rebound. In essence, consistent contributions allow your investments to benefit from the compounding effect over time, increasing your chances of retiring early and financially secure. So if you haven't already, consider setting up automatic contributions to your investment accounts as a crucial step towards achieving your financial goals. Habit number 3. Stay the course. Stay the course is a golden rule in Dave Ramsey's investment playbook. In the world of investing, emotions can be your worst enemy, especially during market downturns. Dave Ramsey reminds us of the critical importance of keeping a steady hand when the market takes a dip. History has shown us time and again that markets are cyclical. They go through periods of growth and decline. But here's the key point Dave emphasizes. Despite these downturns, the market has always recovered, often reaching new heights. Selling investments in a panic during a market downturn can lead to significant financial setbacks. Instead, Dave encourages investors to adopt a long-term perspective. By staying the course, you're allowing your investments the time they need to rebound and potentially grow even more. In fact, some of the most significant gains in the stock market have occurred shortly after major downturns. So remember, stay the course isn't just about holding onto your investments during tough times. It's about having faith in the resilience of the market and the power of time and wealth creation. In habit number 3, Dave Ramsey provides a vital lesson in patience and discipline, two traits that can significantly impact your journey to early retirement. Habit number 4, seek professional advice. Seeking professional advice is a testament to Dave Ramsey's commitment to helping individuals make sound financial decisions. While self-education is crucial, Dave understands the value of enlisting the expertise of a certified financial planner. A certified financial planner, CFP, brings a wealth of knowledge and experience to the table. They have a deep understanding of financial markets, tax laws, and investment strategies. What makes them invaluable is their ability to tailor financial plans to your unique circumstances. They consider your goals, risk tolerance, time horizon, and any specific concerns you may have. Investing can be complex, and navigating the intricacies of the financial world can be overwhelming. A CFP acts as your financial GPS, guiding you through the labyrinth of investment options and helping you make informed choices. Moreover, a financial planner can help you adjust your investment strategy as your life circumstances change, ensuring that your financial plan remains aligned with your goals. Habit number 4 is a reminder that seeking professional advice is not a sign of weakness but a smart move toward financial success. With the guidance of a qualified expert, you can optimize your investment strategy and increase your chances of retiring early with confidence. Habit number 5, live like no one else. Habit number 5, live like no one else, encapsulates Dave Ramsey's overarching philosophy of financial responsibility and discipline. It's the cornerstone of his approach to achieving early retirement and lasting financial freedom. Living like no one else means making conscious choices that set you apart from the norm. It involves resisting the temptation to keep up with extravagant lifestyles or excessive spending. Instead, it's about living below your means and making prudent sacrifices along the way. This discipline has far-reaching benefits. By foregoing immediate gratification and adhering to a frugal lifestyle, you free up resources to invest and save for your future. It's about delayed gratification, sacrificing today's luxuries for tomorrow's financial security. The long-term rewards of living like no one else are significant. You can accumulate wealth at a faster pace, achieve financial independence, and ultimately retire early with the peace of mind that comes from knowing you've made smart financial choices throughout your journey. This underscores the profound impact that personal discipline and financial mindfulness can have on your path to early retirement. So remember, the sacrifices you make today can lead to the financial freedom you desire tomorrow. Habit number 6, maximize retirement contributions. Maximizing retirement contributions is a pivotal step in Dave Ramsey's strategy for early retirement planning. It's about supercharging your retirement savings by taking full advantage of tax-advantaged accounts like 401ks and IRAs. By contributing the maximum allowable amount to these accounts, you not only secure your financial future, but also enjoy immediate tax benefits. Contributions to traditional 401ks and IRAs are often tax-deductible, reducing your taxable income in the current year. This not only lowers your tax bill but also allows your investments to grow tax-deferred until retirement. Moreover, the power of compound growth cannot be overstated. The earlier you contribute and the more you contribute, the more time your investments have to grow exponentially. It's like planting a financial seed that flourishes over time. Dave Ramsey's emphasis on maximizing retirement contributions is a proactive step towards early retirement. It ensures that you're making the most of every opportunity to build a substantial nest egg, setting you on a trajectory to achieve your retirement goals with confidence. So, don't underestimate the impact of habit number 6 on your financial future. Habit number 7, diversify your investments. This is a fundamental principle that lies at the heart of Dave Ramsey's investment philosophy. It's all about not putting all your financial eggs in one basket. Diversification is like a safety net for your investments. By spreading your money across various asset classes, you reduce the risk of a single investment's poor performance having a devastating impact on your overall portfolio. Stocks offer growth potential, bonds provide stability, and real estate can offer a hedge against inflation. Furthermore, diversification extends beyond just asset classes. It also involves diversifying within each asset class. For example, within the stock market, you can diversify by investing in different industries or regions. Dave Ramsey's recommendation to diversify isn't merely about chasing returns. It's about managing risk intelligently. While it may not guarantee that you'll always have winning investments, it helps protect your portfolio during market turbulence and enhances the probability of achieving your long-term financial goals. This underscores the importance of a well-balanced and resilient investment strategy.